studying your last two. I swim med when I turned in. The staring down to mute. And can learn a pole that some kid died.
Now that we've studied the individual Schedule 1 adjustments, it's time to see how they all come together in a real corporate tax return. In this example, we're looking at the completed Schedule 1 for Ritesoft Inc. Rather than learning a new tax rule, the goal is to understand how Schedule 1 acts as the bridge between the corporation's accounting records and the taxable income required under the Income Tax Act. Everything begins with the corporation's accounting net income. This amount comes directly from the financial statements, which have been prepared using accounting standards. At this stage, the income statement includes accounting expenses such as depreciation, meals and entertainment, club dues, income tax expense, and other items recorded according to accounting principles. However, the Income Tax Act does not always recognize these expenses in the same way. This is where Schedule 1 becomes essential. Schedule 1 reviews each difference between accounting rules and tax rules and makes the necessary adjustments. During this reconciliation, non-deductible items such as the business portion of meals and entertainment, recreational club dues, non-deductible CRA interest and penalties, the corporate income tax provision, accounting depreciation, and other adjustments are added back or adjusted according to the tax legislation. The result is an amount that reflects the corporation's income under the Income Tax Act rather than under accounting standards. Once all of these adjustments have been completed, the corporation arrives at its taxable income. This taxable income is then used throughout the remainder of the T2 return to calculate the corporation's actual income tax liability. The most important idea to remember is that Schedule 1 does not calculate accounting income, nor does it calculate the corporation's tax payable. Its role is much simpler. Schedule 1 takes accounting income as the starting point and adjusts it so that it complies with the Income Tax Act. In other words, Schedule 1 is the reconciliation between accounting profit and taxable income. Once you understand this overall purpose, all of the individual adjustments you've learned from meals and entertainment to depreciation and capital cost allowance fit together into one logical process. This completed case study shows that every adjustment has a specific purpose, and together they transform accounting income into the taxable income used to prepare the corporation's T2 tax return. Now let's walk through a completed Schedule 1 and see how all of the adjustments we've learned appear together on a single form. Remember that Schedule 1 always starts with the corporation's accounting net income. This figure comes directly from the financial statements and represents income calculated using accounting standards, not tax rules. From that starting point, we begin identifying items that are treated differently under the Income Tax Act. The first group of adjustments consists of add-backs. These are expenses that reduced accounting income but are either not deductible or only partially deductible for tax purposes. Some of the most common examples include the non-deductible portion of meals and entertainment, recreational club dues, CRA interest and penalties, the corporation's income tax provision, and accounting depreciation. Each of these items is added back because the tax rules do not allow the same treatment as the accounting records. As you move down the form, you'll also see deductions that are specifically allowed for tax purposes. One of the most important deductions is capital cost allowance, or CCA. Notice that CCA does not come from the financial statements. Instead, it is calculated separately on Schedule 8 and then deducted on Schedule 1 according to the Income Tax Act. Other allowable deductions may also appear depending on the corporation's circumstances. After all of the required add-backs and deductions have been applied, the result is the corporation's taxable income. This is the amount that flows into the T2 return and is used to calculate the corporation's income tax liability. One helpful way to read Schedule 1 is to think about the color coding. The green section represents the starting point accounting income from the financial statements. The red section represents add-backs that increase taxable income, because the accounting treatment is not fully accepted for tax purposes. The blue section represents deductions that are specifically allowed under the Income Tax Act. Finally, the gold section represents the corporation's taxable income after all adjustments have been completed. The most important lesson from this completed example is that every adjustment on Schedule 1 exists because of a specific tax rule. Schedule 1 is not a list of random adjustments. Each line reflects a difference between accounting standards and the Income Tax Act. Once you understand the purpose behind each adjustment, reading and preparing Schedule 1 becomes a logical step-by-step process rather than simply filling in numbers on a tax form. This completed Schedule 1 brings together everything you've learned throughout this chapter. Rather than introducing new tax rules, it shows how all of the individual adjustments work together to convert accounting income into taxable income. The process always begins with the corporation's financial statements. These statements are prepared using accounting standards and produce the company's accounting income. This is our starting point, but it is not yet the amount that will be taxed. The next step is Schedule 1. Here, we identify every difference between the accounting rules and the Income Tax Act. Non-deductible expenses are added back, allowable tax adjustments are made, and the accounting income is gradually transformed into income that complies with the tax legislation. One of the most important adjustments involves depreciation. Since accounting depreciation is not deductible for tax purposes, it is added back on Schedule 1. The allowable capital cost allowance, or CCA, is then calculated separately on Schedule 8 and deducted according to the tax rules. Once all of the required Schedule 1 adjustments have been completed and the appropriate tax deductions have been applied, we arrive at the corporation's taxable income. That taxable income then flows into the T2 corporation income tax return, where the corporation's income tax liability is calculated. Looking back over this chapter, you've learned several important concepts. You now understand the difference between accounting rules and tax rules. You've learned how to identify common add-backs, including meals and entertainment, club dues, CRA interest and penalties, income tax provisions, and accounting depreciation. You've also learned that some deductions, such as capital cost allowance, are calculated separately under the Income Tax Act rather than coming directly from the financial statements. Most importantly, you've seen how Schedule 1 acts as the bridge between these two systems. This foundation is essential because the next major topic in the course is Schedule 8. In Schedule 8, we'll move beyond the basic concept of CCA and learn how to calculate it in detail. We'll explore CCA classes, the half-year rule, recapture, terminal losses, accelerated investment incentive, immediate expensing, and other important capital cost allowance rules used in corporate tax preparation. So remember the one key idea from this entire chapter. Schedule 1 starts with accounting income, removes items that are not deductible, applies deductions that are allowed under the Income Tax Act, and produces the corporation's taxable income. Once you understand that process, you've mastered one of the most important building blocks of corporate tax preparation and are ready to move on to the more advanced CC calculations in Schedule 8.